Hi, Darshan. There you
Hey,
are. Welcome, welcome. All right, I'm going to let you take it away so we don't we stay on schedule. But Darshan has a credit infrastructure platform for institutional trading. Darshan, why don't you go ahead and take it away?
yeah, sure. Thanks very much for having me. Just going to share my screen for a short presentation. My name's Darshan. I'm founder and CEO of Xmargin, and I wanted to talk to you today about our credit infrastructure for institutional trading that we're building, built to solve the capital efficiency problems that I've faced firsthand in the fragmented crypto ecosystem. So, as I said, like the business was founded to solve capital efficiency issues that I faced myself as an early market maker on some of the largest derivatives exchanges in crypto. Um, we had a real problem with capital efficiency. So we were trading across multiple exchanges and unable to get credit across these exchanges. And so didn't really see any businesses trying to solve for that in a way that made sense for this particular industry. So the limitations from a regulatory perspective, balance sheet limitations, and just the general fragmentation of this particular space that's much more than the standard asset class. And so we decided to approach this from a technological perspective. And we today facilitate credit by calculating and distributing risk metrics of a trading firm while preserving the privacy of that trader's data. So delving into that further a little bit, we should probably look at how traditional clearing today does things. And you could probably split what a clearinghouse does into two parts. One is a trading firm comes to them to trade through them, and the clearinghouse acts as a risk calculator, is able to calculate their overall risk across all of their counterparties and be a neutral regulated arbitrator of risk, and is trusted because they're regulated. And it's able to net out settlements, net out margin usage, and then settle effectively. And then the second part of it is obviously a very important part as well, which is being the backstop to all of the trades that go through. And so they use their balance sheet to be that backstop. And our goal really is to find a more robust competitive structure for clearing that would be flexible enough for the growing crypto industry and also improve upon the traditional finance approach that we have today. So clearinghouses are not very sexy, and so they're not often in the news, but their weaknesses have probably come into more focus recently with the stuff with GameStop and Robinhood, and the issues that sort of surround whenever you have only one source of credit for accessing trading. And so we feel our way would have been a more scalable approach and would have performed better in stressful situations like that. So to delve into the technological approach, like what did we build to compete with that clearinghouse model? And what we decided we needed to solve that first part, the risk calculator function, is we needed to build a trusted source of truth for that risk calculation, and that doesn't have the ability to influence those metrics in any way. So why is privacy pivotal to that? So privacy enables trust and it eliminates bias. So if you could think of our technology as a black box that can be run independent of us if you want it to be, and it can calculate this trading firm's risk at speed, but is provably accurate and provably done without revealing any data. It ensures the neutrality of the outputs that are coming from it. So the risk calculation function has been replaced with SGX enclaves and zero knowledge proofs. So why SGX enclaves? So SGX enclaves are private, trusted hardware execution environments that can do super fast calculations without revealing the underlying data. And this is the foundation of nearly every confidential computing platform that exists out there at scale. And but we went one step further. We prove that these enclaves are trustworthy by overlaying very, very fast zero knowledge proofs. For the proofs that we do, we believe we're the fastest out there. And we prove not only that the data was private, but also that the computations are accurate. So when you have these proofs attached to the computations, they prove that the data was private, but also they validate the computation, and they remove the requirement for any sort of consensus. And then the second part is something that when you've unbundled it from the clearinghouse model, you can make it more competitive and have that backstop be crowdsourced as opposed to just dependent on one particular provider. So our roadmap is we built this really fast risk engine that can work independently of the privacy preservation. We already provide that for exchanges and hedge funds, and they use that to control and manage their internal risk systems. But we built upon that for this particular credit product, which is now our main focus, and it leverages this privacy preserving infrastructure by monitoring trading firms' risk in real time and then sharing that with sources of credit. So we have more than 20 institutional clients using it today, with some very large firms that we're going to announce shortly from the lending side of things, and have many of the large market makers already signed up. And we're a few weeks into the launch, and we're monitoring over $200 million of assets for the purposes of lending as of now. And what's also exciting is that we can build upon this architecture, not just for credit facilitation, but for portfolio optimization or trade compression, which is a multi-billion-dollar industry in itself if you look at the likes of Trioptima, etc. And so we're really excited about the potential that this has to improve capital efficiency within trading. So if we delve into the first product, which is Xmargin Credit, we probably first should look at how crypto credit is today. And there's a misconception that there is a lot of leverage in crypto. Now, instruments on exchanges, yes, they're leveraged, but for trading firms themselves, the access they have to leverage across exchanges is actually not that much. Most of the loans are over collateralized, and there isn't much access to credit because there isn't this central intermediary or a lot of trust out there. So obviously a normal solution in traditional finance is prime brokerage, and I think that is an appropriate solution for certain users, but the ethos of it is concentrating my lending or borrowing as a trading firm to one single provider. And it's sort of converse to the ethos of this space, which we believe competition for credit is a good thing. You only have to look as far as DeFi to sort of cement that thesis. So today, lenders don't have any visibility on what borrowers are doing with their funds. So, and this severely hampers the amount of leverage a trading firm can get. So what we do is provide real-time credit monitoring between lenders and borrowers, which is a unique bridge that doesn't exist anywhere else today. And lenders use our products to track that capital that they've lent out, get real-time updates and visibility into the size of a borrower's risk, but without revealing the granularity or anything private about that particular borrower. And they also have the ability to evaluate new borrowers by assessing their historical scores over a period of time. And the impact for trading firms or borrowers is better credit terms. There's obviously more visibility for lenders and the ability to build long-term credit scores on verifiable data. So importantly, they don't have to trust us as the risk arbitrator, as we are provably neutral, as I was saying, and don't have to reveal any of these positions when they try and source credit from multiple different venues. And so, like when I say multiple venues, lenders can take many different forms. There's obviously the centralized lenders, which we work with today, but also DeFi applications and exchanges themselves who can be sources of credit. So the product itself is extremely configurable in terms of what metrics you share. We currently have 11 exchange venues for spot and derivatives already integrated, but we are looking to add many more over the next few months, and also integrate with someone's DeFi activity and their other custody solutions outside of our existing integration. So we've already integrated with Fireblocks, but we hope to integrate with banks directly, such as like Signature and Silvergate. So yeah, we're working on those integrations to get us a better picture of someone's credit score. And when we look at credit risk management, it's based to some degree on trust, but also there is two other main pillars, which are information, which is kind of what I've been talking about, our credit tool, and control. And so that's why our partnership with Fireblocks is super important, is that it enables some sort of control, that they're able to enforce on the funds that are lent to a particular borrower. So when the funds are within this walled garden that's built by Fireblocks, they're able to restrict the funds to n number of exchanges that are approved by the lender. And so the lender then has a lot of security and is able to provide better credit terms. In effect, this leads to multi-exchange margin lending and results in a higher degree of portfolio leverage for the trading firm while still improving the risk management for lending firms. And so, as I was saying, we're super excited about where this can lead to as well, which is portfolio optimization. We're still developing that and expect to have some progress by middle of this year, and start rolling it out with our partners like Paradigm. And it's an extension of the architecture that we have today. So it fits with the overall ethos of optimization, margin compression, while disintermediating the need for a central role and still preserving the privacy of the traders' positions. Like, this black box approach can basically lead to a more efficient and scalable solution like Trioptima, but across multiple venues without necessarily needing to trust one person with your position. You can think of our black box like technology as a non-invasive risk engine which can be used to perform some of the functions of a broker. So for example, if I'm long on exchange A and short on B, and someone else is the opposite, then we can get matched in an anonymous way and execute at a favorable price, and both benefit from capital efficiency. And so we're excited about where this can go over the next year, and we're looking to enable more independent node operators of these of this software, and also open source some of this technology stack to make it more trusted, and be able to configure incentive mechanisms to grow a credit risk and clearing network. As of now, the team is distributed across the globe. We have people in Brazil, Russia, Ireland, Italy, California, and we plan on sticking with this distributed nature. Even though it creates challenges, it really allows us to capture a really high caliber of talent in this niche areas of expertise that we work in. And so to that point, the team is largely built of people with quantitative development experience and trading experience and risk management experience, along with cutting edge cryptography and privacy preserving technology. And our investors are also very strategic and influential in the space, that have been really helpful at growing our product. And we've also formed some really strong partnerships with firms that are looking to solve similar problems to us, like Fireblocks. And we're looking forward to announcing some really exciting partnerships in the near future. If you're interested in talking to us, please feel free to reach out, either via any means to do with this conference, or via our website at xmargin.io, or on Twitter at xmargintrading. I'm happy to take any questions.
Great. All right. Well, thanks so much, Darshan.